That's what Key West needs, more eligible bachelors.
Maybe more eligible bachelors that are closer to my age, though I'm not like 60.
I was just going to say, you are cougar candy. Hey, it's your boy Chicago Sean McLaughlin. Welcome to the Flow Show. Strazza's here with me. What's up, Strazza?
How's it going?
And we've even got Izzy working behind the scenes, but we just learned that you can't hear his voice. So it's a shame because Izzy has just a beautiful Frank Sinatra intonation. Wouldn't you say?
It's soothing. It's the exact voice I want to hear before we go live.
It's the voice of God hanging right over. It's beautiful. It's beautiful. Anyway, Izzy, shout out for all the great work you do behind the scenes, flipping the charts and making sure we look right. Yeah. All right, so hey everybody, welcome back. We didn't do the Flow Show last week. We had what was going on last week? We had the holidays and things were weird and
yeah.
Anyway, it doesn't matter why, but here we are. It's the Flow Show, and this is the show where we dig into unusual options activity that we're detecting, anything that's really catching our eye as far as unusual options activity. And we want to dig in and see if we can craft some trades here. So Strazza, why don't we pass the mic to you and let's dig into this week's Follow the Flow report. And let's talk about what's standing out to you right now.
All right, let's throw this list up. I'm going to zoom in on it now. Brand new technology. We're zooming in now.
That's hot tech right there.
So the first thing that stands out is the first name on the list, HP, right? This is a name that we like a lot. Not many tech stocks look like Hewlett Packard right now. We also had some very bullish insider activity with Warren Buffett taking a very large ownership percentage stake in the company about 3 weeks back now. So there's a lot to like here. Now we're seeing that bullish options flow. We talk about that a lot, how we see insider activity, then we see bullish options flow. We get that little overlap. Just gives us more reasons to like the stock. We'll come back to that one. Some other names that stand out, Square. That's a big Archean name, trying to find a bottom. It's, these Archie names are starting to see more and more flow, which is probably like a very constructive development. We're waiting to see price kind of confirm that bullishness. Haven't seen much yet, but they're at least appearing on the list. Turtle Beach Corp is another one that's like a gaming headset company, very growthy. From a bearish perspective, what stands out is KB Homes. So that's KBH. The home builders have really been under pressure. The list of cyclical, pro-cyclical, I call them economy stocks, whether it's the banks, the transports, semiconductors, home builders, the list continues to grow of these key sectors that are showing weakness. Home builders would be at the top of it. And then again, it's oil and gas, right? The oil and gas names really stand out. This week we have IMPP, WTI, a little bit gappy, these charts, a little bit crazy. Yeah, look at that. No good.
WTI has had a nice move today.
Yeah, if you ignore that blow off top, let's do this. Let's look at WTI. If you ignore that blow off top, what was that, earlier this year?
Yeah, it was end of March, looks like, or end of February, excuse me.
You have some nice basing action. If you just literally draw, and when you see moves like that, and there's obviously a level of interest beneath it, I draw my line straight through it.
So just to be clear here, you're showing a daily chart that does not have today's candle there. If you look at my screen, you could see
look at that
pretty significant green candle today.
What are we up? What are we up by?
We are up 11% today, WTI.
Wow. So
trading
oil
at 490.
Yeah. So oil stocks coming into the week again with a huge, up day to kick off this week. It's just Monday now while we're talking about this. And this is one of the names that was seeing bullish call flow last week. So now it's up, 10% to kick off the new week. Maybe somebody had an idea, knew something. But I really think this is just a secular move because there's so much strength in this group right now. If you look at energy, just like on a sector level, it's nice, tight coil, really, really textbook continuation pattern, looks ready to go. So this is the kind of place where we want to pick our best spots, pick the leaders, pick the best vehicles to express a bullish thesis on energy, because the sector just looks as good as possible right now. This is how I would look at WTI. Well, are we above $5 today?
We are at 491 as we're speaking.
Right, so you're right there. So we're literally right here at the breakout level. A little bit more strength tomorrow. That is a 12-month base breakout, longer if you ignore the little blow off. So
well, let me drop a caveat here real quick. On a stock like this, a sub $5 stock, I mean, do we really need to buy options on a stock that's so cheap? I mean, why not just buy the stock, right? But that said, if I was hell bent on buying options in this stock right now, I'd be mindful of the fact that the implied volatility is pretty high. If you look on my screen here, the bottom of my screen, I got these blue squiggly lines here. This is the implied volatility. As you can see, it's relatively high compared to where it's been over the past year. So you're going to be paying some sweet premium if you're going to do this with options. So, I mean, we're at 491 right now. Like, just as an example, if I go into the June options chain, which is 60 days to expiration, and if I look at buying a $5 strike option, I'm going to pay 70 cents. I mean, what is that? That's 30% higher. The stock would have to move 30% from here just for these calls to be break even at expiration. So, I mean, as an options player, I don't think this is the best vehicle to trade in options right now. I would rather just buy the common.
Yeah. And I think that's a really good point to make, right? Like, for something like this, at least for our purpose, right? What are we trying to do here? We just want to express a bullish thesis on energy, right? So we know that high level bullish thesis on energy. Then everything else that comes after is finding the right stock, finding the relative strength. And then, like, when we drill in for an option setup, like you said, it's making sure that the implied volatility is right. You know, when you look at that chart of the implied volatility that you just showed, it almost seems like in January, February of this year, we entered like a new higher volatility regime.
Yep, right in here, right around.
Right.
Yeah, I mean, basically from the beginning of the year, we've just been trending higher. I mean, obviously it's choppy, but we've been trending higher overall, which is no surprise.
Let's try another one. Another oil and gas equipment and services name that was on the list this past week. National Oil Well, I forget the last name. They changed the name to NOV Inc. It used to be National Oil Well Varco, I think.
Varco, NOV, yeah.
Right? Yep. It's not NOV Inc. Whatever. This is an old name. Used to trade this one. Let's see. How's it looking? We got a nice base there.
I like that chart.
Ooh, look at a nice little base breakout. You had a nice leg up. Here, let's draw it. So showing on my chart now, this is a nicer setup than WTI. Let's talk about why. So similar on the lower pane here, what I'm showing is just the relative strength. Like I was just saying, we want to be in, we know we like energy. So this is not a matter of finding, the perfect stock. It's a matter of finding the strongest stock within energy. We know where we're fishing, right? So you have this nice base on a relative basis, new highs relative to the S&P. And now it's just kind of like flagging. It came back, a little throwback to check in on those former highs here. Let's see if it digs in at this potential support level, moves higher on a relative basis. I'll tell you one thing, something we do look at quite often for stuff like this is when the relative trend starts to make new highs and resolves higher, then it makes us say, okay, the absolute trend is likely to follow, and vice versa. So in this case, I would be looking at the absolute trend and saying, look at this tight little coil here. If you, again, ignore that blow off move from earlier March. That's a tight coil. When this flag resolves, this thing probably enjoys a nice leg higher, and this relative trend is likely to, resume its uptrend, which means that we have leadership here. So this one I like a lot. We could define a risk at the former highs here too. So the risk reward.
One thing to be mindful of here with NOV is we've got earnings coming up on April 28th. Yep. So that's going to put a bid in the option prices, which is not necessarily a bad thing, depending on how we want to express a bet here. If we want to leverage the higher options implied volatility in our favor to get into a trade here, maybe the move would be to sell some naked puts or sell a put spread. I think I would probably lean towards selling a put spread with defined risk, with the earnings situation coming up. Maybe looking into May options. Let's see what the May options chain here offers. Let's see, the 25 Delta strike is right around here. The 19 strike, it's getting 70 cents. It's a $20 stock, so it's not terrible. Actually, let me look back at the chart here. We have support just below, we'll call it 1850. So maybe the 18 strike would be a nice, comfortable spot to sell.
Yeah, that's the level.
But then we're not getting a whole lot of premium there. We're getting 45 cents if we're lucky in between there. So this would be a tough one to trade, only because of the earnings situation.
If you go to 19, you're only collecting 65 cents.
Yeah. If you hit the bid, you're getting 65. You might be able to get 70 cents work in the middle there. Yeah. Which, that isn't terrible, but I feel like, we could touch 19 and the trend, the setup could still be valid. So I'd hate to get stopped out. I suppose we wouldn't have to stop out at 19, even if we sold the 19 puts. We could maybe still use 1850 as our stop out level. But yeah, maybe the move is to sell 19 puts.
Yeah. So basically what you're trying to say is when options premium is elevated, like it is in this name, you can see it in the lower pane, we want to be net sellers of premium.
Generally speaking, yes. I say that hesitatingly right now because of the upcoming earnings situation. We have a binary event on the horizon, and we've all seen it. Stocks can go up or go down 20% following an earnings report, and this stock would not be immune to something like that. So, generally speaking, I don't like selling naked premium ahead of an earnings report. So with that said, if I really had a strong feeling about this one, if we're seeing, which by the way, someone does have a strong feeling in this stock, right? This is showing up on the follow the flow report. You could buy calls here. You will pay more than you might like to, but that's the only way you can do it and define your risk, or that's the best way to define your risk. So maybe the call buyers know something there, Strazza.
Could they just be technicians, right? And they're looking at these high and tight coils, these super bullish continuation patterns. Because as a technician, I'm hearing what you're saying. I'm like, yeah, premiums are juiced. Well, they should be. These things are about to rip.
Well, let's play devil's advocate here. Let's say that we're not making a prediction about earnings, but let's say the earnings report tends to be either a non-event or favorable to price action here. If this thing were to start moving, what kind of price target should we be keeping in mind here?
For NOV particularly?
Yeah.
Oh, like the way we would do this. First, I want to find existing price memory. So I just zoomed out on the chart. Yeah. So if we were at new highs, I'd be drawing Fibonacci extensions, as you know, but we're not, right? We have shelves of former highs, key levels of interest over the past several years that we can use as a little roadmap. For taking profits or picking our spots along the way. This is the first obvious one that stands out. And, it's not rocket science. I'm literally just looking at the touches of this trend line, horizontal support line. You could see it right here. This level is important. I don't know why, but the $25 level has acted as both support and resistance just over the past several years. When we get back there, that's a logical level. Then the next one is something we talk about all the time, which is the 2018 highs. Now they are a bit of a ways away. But it's funny because we used to talk about how the 2018 highs were so far away for other energy names, which are now either there or have reclaimed and eclipsed them, like something like Chevron. Mm-hmm. So during these commodities booms, these stocks will make very, swift moves, aggressive legs higher. That's what we're
Well, looking at the options chain here, if we go as far out as, say, August would probably be about as far as I'd want to go. The option strike, the call strike that most closely corresponds to the 25 delta, which is generally where I like to buy calls if I'm buying straight calls. That strike is 27. So if we could get them for probably $1 or a little bit less. That's not a price that makes me. I'm not too concerned about that price. That seems like a fair price, even though volatility is elevated a little bit right here. We have until August, and that chart you were showing before, if we break through 25, then there's no reason to think that we can't make a serious threat to run towards the 40 level that you or higher than 40. So buying the 27 strike for 90 cents or $1 all of a sudden looks like a great idea.
You're just talking about naked calls.
Yeah.
So
again, because of the earnings event coming up, I don't want to put on any kind of multi-legged spread. I feel uncomfortable selling naked premium here. So probably the cleanest and easiest way, if I wanted to get aggressive right here, I'm thinking the move would be to buy the calls, buy the August 27 strike calls, pay $1 for them. And play for the bigger move.
Yeah, if this thing resolves higher, you're looking at 25. whether or not we take out 25, but that's where this is going on a resolution from this flag. That's the next level.
Yep.
I like that a lot.
Well, the nice thing too is we talk about this all the time. Whenever we buy long calls, our best practice is to sell half of them when we get a double, right? We do that so we could take our original risk off the table and then have a little bit more of a comfortable holding out for that bigger move. And when you go for big moves, there's going to be volatility, right? There's going to be ups and downs. And if we've already taken our risk out of the trade, then it makes it a lot easier for us to weather those storms. And so with that said, if we were to buy these 27 strike calls that expire in August, and coming out of the earnings event, even if we just threaten that 25 level, there's a chance that we might at least be able to sell half of our position to take our risk out of the trade. That's
what's best?
Fair bet.
Yeah, you got nothing to worry about. Let's do a little exercise. Tell me if I'm crazy, because as you know,
you are crazy. You're definitely crazy. All right, but go ahead.
Am I crazy for this reason though? So I like to, when I'm very bullish on a stock, I own the common. I like to get a little juice and put on naked calls, as you know, right? So when earnings is coming up, it's a pain in the ass for me because I don't want that extra premium, in the calls that I'm buying. I don't want that. So does it make sense? Because we do have this phenomenon in markets where stocks that are about to beat and stocks that are about to not beat will either run up or fall ahead of earnings. So I'm kind of trying to catch that move. So I'm in Rig and Oxy right now for oil names. And my expiration is just a few weeks out because I want to make sure that my options contract does not run into the earnings event because then the premium will be that much more. Does that make sense?
Right. What you're talking about is as we approach an earnings event, all else being equal, even if the stock is going sideways, not doing anything, as we get closer to expiration, the premiums and options tend to rise. And that's because players are maybe getting a little bit nervous about what's going to happen with the earnings. So they're hedging their risks. They're buying puts to protect their long call or their long stock position, or they're taking speculative bets thinking that the stock's going to rip coming out of earnings. So they're buying calls to take advantage of that. Either way, both participants' actions rise the premiums that are being offered in the market because people are bidding up the cost of these options. So implied volatility typically will rise heading into an earnings event. Now, there's a whole school of thought out there that some people smarter than me have put out all kinds of studies that say, hey, maybe a great strategy is finding a stock about 2 weeks to expiration, 2 weeks to earnings, buying an at-the-money straddle. So that a straddle is a at-the-money call and an at-the-money put. They pay for that. It's a debit trade. Right. You buy it and you get out the day before earnings. And you benefit from that rise in volatility. And as long as that rise in volatility overcomes the theta drag that's endemic in options, you have kind of an easy win. Now, I haven't really done that kind of trading, Strazza, but I've read about it and it sounds interesting, but I don't know if it's so easy, everybody be doing it, right?
I was going to say, theoretically, it sounds like a no-brainer, but then at the same, the first thing that I would say is well, the market's forward-looking. Can it really be that easy, right? Shouldn't that be priced into the primo?
You would think. But the real magic sauce is that you have to the amount of increase in volatility has to compensate for the theta drag that you're going to have during that time, and that's a delicate balance. And the theta drag is going to be very real if you're trading them that close to earnings. Right, exactly. So, like I said, smarter people than me have done this research. I mean, I haven't found it to be entirely conclusive, but it's certainly interesting. And maybe one of these days I'll go down the rabbit hole and really look into it.
No, I like that. We should talk about it because I like the idea of I was looking into recently, some sort of strategy where you're literally investing in stocks with strong fundamentals ahead of earnings, trying to catch market participants pricing in a positive beat into the stock, 3-4 weeks before the report, and then you're out before it. Might be something there. I don't know. No, hey, I know a CPA turned technician who's doing that. So I've been kind of following along. I really like the work. So.
Well, hey, you'll be happy to know that the options trade I put out today for All Star Options subscribers came from last week's Follow the Flow report. So, hey, we find great trades here all the time. It's one of our more valuable scans. And again, we talk about this every week when we do these calls, is that just because a name pops up here and we see a certain strike and a certain expiration series being aggressively bought or sold, that doesn't necessarily mean we want to put on that exact same trade. We're not, like, for example, the top of the list there, you got HP. We saw some bullish action on the calls on the 40 strike options in April, that April 11th.
Yep.
No, I don't know if that's the right expiration there, but either way, there you go. Zoom out. April 14th. So it doesn't necessarily mean we want to trade that same contract or that same strike. All that really tells us is that, hey, people are getting aggressive here. There might be a reason for us to be bullish besides just the chart pattern. Yeah. And it catches our attention. And that's really how we're using this list. I know there are people out there who like to game these exact trades and take the other side of them, or somehow play off them, but that's not really what we're trying to do.
The beautiful thing about this list is the stocks that we put out long ideas on from this list are stocks that, based on the chart pattern, we would want to be long anyways. There's just the extra kicker in these instances, in the sense that there's also very bullish flow. So we know that the smart money or institutional money is also, investing in the same trend with us. And it's always nice to have that at your back.
Right. It's just like that extra level of data confirmation that says, hey, maybe we're onto something here. And other smart people with big money agree with us. So that gives us a little bit more confidence. That's really it, right?
We're like, it's like conviction stacking instead of habit stacking.
Conviction stacking. There you go. That's the tagline for the show right there. All right, we're going to put a pin in it right there. This has been the Flow Report. We try to do this every Monday afternoon. Me and Steve Strazza and Izzy behind the scenes. Izzy, we see you. We can see you. Anyway, thanks for tuning in, and trading well this week. And we'll be back with you next week with the Flow Show. Take care, everybody.
Bye, everyone.